Hello, everyone. I'm David Warshaw, Certified Financial Planner at the Wealth Plan LLC. And today we're breaking down 5 smart tax strategies every business owner should be using to legally keep more money in their pocket and not the government's. Let's get to it. Tip number 1, business expense optimization. This is a big one, and if you get this, you're golden. Most people live on after-tax dollars. But business owners, the script is flipped. Business ownership lets you turn everyday expenses into tax deductions. Here are some examples of what you can legally write off as a business owner. Your cell phone, internet, auto expenses like lease payments, gas, maintenance, and insurance, your dedicated home office space, health insurance premiums, and lastly, education-related expenses like if you take courses, attend workshops, or buy books that directly improve your current business or skills, you could likely write them off. Now, some of these expenses are fully deductible, while others are only partially deductible. And I want to be clear, this isn't a loophole. It's just written into the tax code, literally. Tip number 2, deducting ordinary and necessary business expenses. One of the biggest tax advantages for business owners is deducting ordinary and necessary business expenses. But what does that actually mean? Well, ordinary means it's common in your industry. Necessary means it's helpful and appropriate for running your business. If it's legitimate, used for business and not personal, it's probably deductible. Some examples here include office rent, employee wages or independent contractor payments, marketing and advertising, supplies, software, and equipment, travel and meals within reason, professional services like legal or accounting. Look, the IRS isn't dumb, so keep good records and don't mix business and personal. Tip number 3, the QBI deduction. If you're self-employed or own a pass-through business, you may qualify for the Qualified Business Income Deduction, or QBI for short. This allows you to deduct up to 20% of your business profits before income tax is calculated. So, for example, if your profit is $100,000, you might only pay taxes on $80,000. And the best part, you don't need to jump through hoops. It's built right into your tax return if you qualify. Now, income limits do apply. For 2025, it phases out starting at $394,600 for joint filers and $197,300 for other filers. It's also set to expire after 2025 unless Congress extends it. So use it while you can and keep an eye out for that. Tip number 4, the W-2K1 income splitting strategy. Yeah, it's a mouthful. This one's for the S-Corp owners. Here's the idea. You pay yourself a reasonable W-2 salary. Keyword being reasonable, which is subject to Social Security and Medicare taxes. But the rest of your profit comes through as something called a K-1 distribution. That K-1 distribution is not subject to that 15.3% self-employment tax. That shift alone can save you thousands of dollars each and every year. You heard that right, 15.3% tax savings. That's what's up. But don't get cute. If the IRS thinks your salary is too low, hence unreasonable, they'll reclassify the income and stick you with penalties. Not a good idea. The drawbacks to this strategy are that low W-2 wages can reduce your Social Security benefits, limit your retirement contributions, and add cost and complexity. Bottom line, it's a very powerful strategy when done properly. And finally, tip number 5, max out your retirement plan contributions. When you have your own business, you can now set up your own retirement plan. Solo 401k, SEP IRA, Simple IRA, or even a cash balance pension plan. And by funding these plans, you receive some of the most generous tax perks out there. Contributions are usually tax deductible, grow tax deferred, and can even be withdrawn tax-free if you use a Roth feature in your plan. It's a win-win. You reduce this year's taxes while building long-term wealth. For small business owners, it doesn't get much better. But remember, These plans come with their own rules, costs, and deadlines. So choose wisely or risk penalties and missed savings. And bonus number 6, hire your kids. You heard that right. Want to shift your income from your high tax bracket to potentially a 0% tax bracket? Hire your kids. You pay them a reasonable wage for actual work, deducted as a business expense, and typically, if they earn less than the standard deduction, which is $15,000 in 2025, they will pay 0 in federal income tax. You save on taxes, they earn tax-free money, and the IRS is fine with it, as long as you follow the rules. Before we wrap up, you deserve a YouTube treat for hanging out with me this long on a tax video, no less. Check out Your Friends and Neighbors on Apple TV. This dark comedy stars John Hamm, and my wife and I are addicted to it. The first season is still going on, and we are really enjoying it. Check it out. All right, final thoughts. Running your own business comes with some incredible tax benefits, but you've got to play it smart. Work with a good accountant. They're not an expense. They're an investment that pays for itself in tax savings and peace of mind, because the last thing you want to deal with is an IRS audit. Use the code how it's meant to be used and keep more of your money working for you. Thanks so much for watching, and I'll see you in the next video. Take care. Bye-bye.